the liquid staking report from Chorus One was really incredible, and I think they've done a phenomenal job outlining all of the pros and cons and the different varieties of liquid staking. So I was thrilled just to learn a lot about it, talk to them about it, learn from them about it, because they really are, in my view, the premier experts on the new, sort of emerging staking ecosystem. So my contribution, I would say, is comparatively modest and maybe to some even boring, which is the legal side. But I find it interesting, and I know some of you do. I know the Course One guys do. Yeah, huge debt of gratitude to them from the community for putting this together, and definitely don't want to let the legal side outshine everything else in the report, which is wonderful. But with that being said, I will jump in here and try to give you guys an overview, because the interesting thing about liquid staking, like a lot of DeFi-ish things, is that it's very complicated from a legal point of view to analyze, and it's very uncertain from a legal point of view to analyze. These are indeed cutting-edge technologies. Law has traditionally been developed for hundreds of years in a world where everything had to be intermediated because there wasn't really a way of doing things on a disintermediated basis. Now we have these decentralized systems, and the task of lawyers like me and regulators and legislators and a lot of other people is to try to fit that square peg into a round hole to some extent, and that can't be done, obviously, when you phrase it that way. So that means the law also has to evolve. So the way to view this exercise is really how might lawyers and regulators think about the legal implications of these technologies? What's kind of the menu of issues that are relevant, but not to say that we know for sure exactly how those issues pan out, because I don't think anybody does. Just to give you an earlier example in the evolution of blockchain law, when ICOs were happening, there were huge amounts of debate about how and whether the securities laws apply to them. And I don't think anyone could have even remotely predicted that the SEC would come out and start saying that the securities laws apply differently to a decentralized system than to a centralized one, right? That was very surprising even to lawyers who'd been in the space a long time. So there might be similar things with the regulations we discuss here, but we'll have to see how it plays out. And I hope you all will be instrumental in educating regulators and lawyers and making this come out the right way that sort of honors the purposes of the technology. Really, there are two ways to think about the law. One is what I call legal engineering, and another is more regulatory, and both are equally important. Legal engineering, for the most part, refers to entering into like written legal agreements that spell out terms and conditions and rights and obligations and remedies and dispute resolution mechanisms and so on. Sometimes legal engineering can also be done in like statutes, right? Laws that legislatures pass, but we're not legislatures, so that's not going to help us very much. I leave that one to the lobbyists. We won't touch on that here. And then the other side of it is the side people more typically think about, which is regulations, right? There's a rule that you can't offer or sell securities unless they're either registered with the SEC or there's, it falls under a relatively short list of exemptions for unregistered offerings, that type of thing. There's another rule that if you are a money services business, meaning that you accept value from certain persons and transmit the value to other persons, that you have certain obligations to register with banking authorities and to report suspicious activities and so on. This sort of thing, those are regulations. So we'll discuss both those aspects. So in general, my framework here is that there's a spectrum of sort of how crypto native a solution is. That is, how much it gets rid of any need for off-chain mechanisms or social mechanisms, and how much legalism is required in the solution, right? So I think, in my own opinion, I think that when a solution has high crypto nativity, an example of this would be native liquid staking with native delegation vouchers that are discussed in the report. uh, the legal burdens are likely to be very much lower, both on the legal engineering side and the regulatory side, because the protocol is handling everything, and it's also de-risking everything. So you don't really need the law when it's doing that successfully. Uh, and then, at the other extreme end is arrangements that are purely off chain, right, or almost purely off chain. And there, the legal requirements will be highest because you don't have a protocol, right? So the protocol needs to be the contract, it needs to be the statutes, it needs to be the regulations, and so on. And those things also, pose risks that haven't been mitigated by technology. So therefore, they have to be mitigated by law, right? And so custodial liquid staking is likely an example of this in most cases, right? Because you just have a trusted custodian, or like a cryptocurrency exchange. They're accepting a deposit. If they don't, if there's no contract that says when they have to give the deposit back or what they have to do with it, then there's no technology there to help the customer is just out of luck. So law is highly important there. And then somewhere in the middle are these varieties of smart contract systems that also involve some governance, right? So they have a lot of crypto nativity. There are certain things that are quite automated, but on the other hand, they are also flexible and adaptable. And there is, typically a governance token holders who are going to be in control of managing that flexibility. And so that involves some trust in those people, and therefore one should expect that some legal engineering and regulations would apply. So key questions that we'll ask at a very intuitive level, because I do believe ultimately the law does make sense, even though when you get mired in the details, it can seem counterintuitive, are just very basic things that I think anyone could understand. Does the liquid staking method have trust holes? Information asymmetries that can be abused, custodial risk, that sort of thing. Do individuals need protection when they do the liquid staking against bad investment decisions or potential fraud or that sort of thing? And then finally, does the market need protection, right? Does it need protection against systemic risks developing, the risks of black swans, negative externalities like the fact that terrorists might use the system to benefit themselves, that sort of thing. So let's run through the different types of liquid staking that are covered in the report, and sort of at a high level touch upon what we think the regulatory picture for those might be. So delegation exchange, this is where essentially you just swap staking positions without representing the staking positions as a token. And you could do that on chain through some crypto native, transfer delegation call, or you could do that off chain through some type of legal transaction like a bill of sale that says, I'm transferring you my private keys that control the delegated position, right? So this is very legally straightforward. You're essentially selling personal property or a claim on personal property. Um, and right, the regulations that will apply will not be heavy. I mean, you might have to look at some property statutes like the Uniform Commercial Code, but there's no security involved here. There's no complex commodity derivative involved here. It's presumably a peer-to-peer transaction in effect, so there's no money transmitter issues or anything like that. There's no intermediary necessarily. So these are very straightforward. The B Harvest solution that's described in the report, which use shared accounts, might involve slightly more legal engineering, because now you might be talking about co-ownership or co-management of a stake, but it's still relatively simple. And in my view, I wouldn't see securities regulations, for example, as being particularly highly implicated here. So sort of the next rung is native liquid staking, right? Now here you do tokenize the staking position, but otherwise it's very similar to the delegation exchange we just discussed above. That is, you have a token that's a piece of personal property that sort of entitles you to get other personal property that's currently locked up, to stake with. And one would expect, for example, that native liquid staking, right? It's much like delegation exchange, except now the position is tokenized. So and you know, and again, here the protocol handles everything, right? So presumably, you know, the validator still doesn't need to know who the stakers are, and the stakers don't need to know who, you know, the new person is who they're transferring their stake token to. It's all just handled through the protocol, and it's, you know, trustless. So in that scenario, again, you know, very little legal engineering is required because these people don't need contracts. The blockchain sort of is their contract. And also, you know, in my opinion, regulation is not likely to be particularly implicated, right? You sort of think about it from the standpoint of the issues that we raised earlier. What does an individual really need protection against here? You know, they should have a basic idea of what they're doing if they're even trying to do it. There's not a risk that someone can like steal the stake without, you know, paying them first, really, you know, that sort of thing. So there's not a lot of individual protection concerns, and then there's also not a lot of market concerns, right? Because the tokens in this case are going to pretty literally represent the underlying stake and its risks, right? If people think that there's a high risk of slashing, then that stake token will trade at a discount to, you know, the aggregate of the staking tokens and expected rewards. Excuse me. And you know, therefore, things will be pretty transparent, right? So yeah, that's native liquid staking. Overall, lightweight legal, lightweight regulatory. Non-native liquid staking. Now this is sort of the most complicated, right? Because there are a lot of different flavors of it that are described in the report, right? The basic idea here, though, is that you deposit some staking tokens into a smart contract. You get a stake token that represents your deposit into that smart contract and the right to get the, you know, proportionate rewards that end up being issued on it. And then the smart contract then takes those stakes and stakes them on the actual protocol, right? Accumulates the rewards, right? Puts them back into the smart contract. Then people can put the stake token back in and get the original stake tokens and the rewards out. But there are different flavors of this, right? And I think they actually make a difference which flavor it is legally. So and the other piece here is, you know, whether there's governance, right? So I think a lot of these systems seem to be contemplating that there will be token holders similar to like MKR holders in MakerDAO, and that those token holders will be able to dynamically adjust the parameters of the system, for example, to set interest rates, right, or stability fees, that sort of thing. So how do you characterize the stake token in this instance, right? Here it sort of starts to look more like a legal instrument of some kind. It could sort of be thought of as you're lending the staking tokens to the staking protocol or perhaps to the governance token holders, and then they are taking it and they are staking it, much like a bank would take a deposit, you know, and try to make some money off of it, right? That sort of thing. So it looks a little bit like a loan. It also can look like a loan the other way, right? So it can look like the governance token holders are paying interest to the stakers to stake with their validator rather than another one. So that stake DAO would be an example of that second kind. And then Everett and is it Akala or Asala? I'm not sure the precise pronunciation, but that would be an example of the first type where it looks more like a loan to them. So if it is a loan, right, then we do have lending regulations, right? We have them, you know, on the lender side, they're supposed to make certain disclosures. They're supposed to not charge exorbitant interest rates, that sort of thing. There's, you know, and those may not play super well, right, with a MakerDAO type system, particularly if they have to start, you know, ratcheting up the stability fee to try to keep the stake token value stable, right? Um, and I should point out here, right, for those who might have missed this nuance, the key difference between, you know, a system like Everett and Akala and a system like StakeDAO seems to be the stability, right? So in StakeDAO, you get a stake token that represents your specific stake that you deposited, and it continues to represent that when it's sitting with a specific validator. So in theory, this should most likely end up being risk discounted for slashing, et cetera, just like the delegation vouchers were, right? Now, the difference is at least you get some interest paid, right, to try to compensate you for your capital being locked up. So it's better than a delegation voucher in that way, but it's still similar in that the actual stake token should be risk discounted by the general market. In Everett and Akala, it's different, right? Because they try to make the stake token one for one with the underlying atoms, right? So and then they over collateralize, the stake tokens to do this. So it looks a lot more like MakerDAO, but that is very different, right? Because you are somewhat artificially and through active governance, trying to force this sort of like phantom staking token to have the same value as the actual staking tokens would have if they were freely trading, right? So it's very different. So from a commodities derivative perspective, right? So this regulatory regime in the United States, it's administered by the Commodities Future Trading Commission. Originally their ambit was really all futures, right? But after the financial crisis of 2007, 2008, their regulatory purview was dramatically extended to what we call swaps, right? So they have a very big, assuming all cryptos should at least be commodities. Some of them might also be securities, but so the CFTC sort of effectively gets jurisdiction by default over pretty much everything. But some commodities are very lightly regulated by the CFTC. They're so-called spot transactions, right? You think just an ordinary interest in oil or gas or corn or an ordinary Bitcoin or an ordinary ETH. Transactions in these are just spot transactions. The CFTC has authority to bring fraud actions, but beyond that, they don't really regulate them. On the other hand, there are more complex derivatives. There are futures, right? There are what we call leveraged retail commodity transactions, and there are swaps. And these things are very highly regulated. And in fact, they're regulated under a policy of mandatory intermediation, where they're only supposed to happen on CFTC regulated exchanges, which are intermediaries, of course. They're not smart contracts. So some of these systems could implicate that higher level of regulation, right? For example, think about the Everett Akala system, right? By virtue of you're sort of one way to look at that, right, is that you are acquiring the staking rewards on a leveraged basis, right? Because although ordinarily you would have to just completely lock up your atoms, say, to get those rewards. But in this case, you get the benefit of locking them up and potentially getting the rewards, as well as all the liquidity. So you have this capital multiplying effect, right? And indeed, when you look at MakerDAO, for example, which is similar, the MKR holders are often described as lenders of last resort. Well, what is a futures exchange, right? That's doing leveraged trading. They're also a lender, right? If trading on margin is exactly that, right? You get, say, 5 BTC worth of trading power, for, having 2 BTC in your account. Something similar is happening here vis-a-vis the atoms you deposit, the potential staking rewards you could get, and then the fractional liquidity that you have. There's some type of arguable leverage there. Now, is it completely the same? Not exactly, right? Because you're over collateralizing one piece of it, which is the stake token itself. So we don't know currently whether the CFTC will regard this as the type of transaction that is supposed to only occur on a regulated exchange, but they could, right? And so this is an issue that needs to be figured out. Now, stake DAO is kind of the inverse, right? Because the stake DAO members are kind of like paying stakers to stake with their validator instead of another one, and they're paying them interest, right? But there, it looks, to me at least, it looks a lot more less like a leveraged commodities transaction than just a rebate scheme, so to speak, right? And you could see again that the risk issues, the market risk issues might matter because the Everett and Akala system is somewhat hiding some risks, right? Because it's trying to bring those stake tokens, make them just the same value as the stuff that's locked up, even though there could be a slashing and the system could go insolvent. Whereas on the other hand, the stake DAO stake tokens are actually expected to trade at a discount. And I do think regulators will take that difference seriously and be more apt to be harder on an Everett or a Akala type system than they would on Stake DAO, which is not to say that they will definitely regulate the Everett type systems either, but just that there's a greater risk for those. So the other category, and here I think it's less relevant than it typically is, but of course people always think about the securities laws, right? Here it's a little bit, with most of these liquid staking things, it's hard for me to see how they're heavily implicated. Yes, you do have a staking token, and yes, that can go up in value, and yes, it goes up in value in part based on whether the efforts of the validator, but it's not really the type of entrepreneurial effort that I think is contemplated by the securities laws. It's really just more that they use ordinary care, that they not mess up and have a slashing event. Because if you sort of look at the list of validators, right, on these proof of stake networks, they're delivering very similar returns to all their stakers. So it doesn't seem like one can be like remarkably better than another, and therefore this doesn't look a whole lot like a security to me. Now, the one exception I would say to that is Staker DAO, which is different from Stake DAO. Staker DAO is on Tezos and involves, sort of like almost like a board of directors, as I understand it, that will be appointed to kind of curate custom mixes of different stakes, with a view to making them attractive from an investment perspective. And so when you take into account this work of curation and the representation by an actual kind of body of governors, yeah, that's much more likely to be a security, right, than the other ones are. And it sounds like they're maybe aware of that and maybe embracing that. Another issue, and this is one moment. This is one people don't typically think about, but we have in our tax laws, and most countries have in their tax laws, punishments for so-called bearer financial instruments. So think bearer bonds, right? Bearer bonds used to be this sinister thing in spy novels and stuff. And so governments crack down on them. And the way they crack down on them is just by really making them punitive from a tax perspective. I'm not going to get in a lot of detail on that here. It is in the legal section of the report, but it's theoretically possible that you could view one of these stake tokens as being like a bearer bond, right? Because, it does have this, it gets you money and it gets you more money over time, right? And it's not registered to the name of a specific person. And so it's somewhat similar to a bearer bond. On the other hand, bearer bonds are contractual obligations, right? And stake tokens in these non-native liquid staking systems are more like powers than rights. If you put it into the smart contract, you're going to get something out. So TBD, right? And then there's sort of a money services business issue, right? Because the smart contract system is taking value from people. It's then transmitting that value to someone else, right? Namely the validators. And in theory, that could meet the definition of a money services business. On the other hand, they don't really have the opportunity to know who's doing it or to file suspicious activity reports on them, et cetera. So I think it would be kind of silly, but I couldn't swear to a certainty, that FinCEN, wouldn't treat them as a money services business. So a possible issue, but sort of lower down the list. And then there's the governance token, which I won't spend a lot of time on because it's not integral, to the liquid staking itself. But in theory, that could be a security, right? Because the whole idea of that is that the people who set the parameters will be rewarded through mechanisms that make the value of the governance token go up if they do a good job and down if they do a bad job. And gosh, looks a lot like a security in some ways. So the next one is custodial liquid staking. And this one will be briefer because, it basically has all the same risks as we just discussed for non-native liquid staking, plus more, right? Because now it's fully custodial. So now the legal issues are there's not as much debate around them, right? Like, for example, if there's somehow margin involved in this and they don't actually deliver the stakes and potentially even the rewards back to people, at least once during every 28-day period, it's going to be a leverage retail commodities transaction, and it would have to the cryptocurrency exchange would have to be like a CFTC regulated exchange. They'll need money services businesses approvals in many jurisdictions, which many of the cryptocurrency exchanges already have. The stake token is now no longer governed by a protocol at all, right? It's just governed by how does this custodian treat it. So it's inherently contractual. It's really just a pure contractual instrument, a receipt of some kind that the custodian has agreed in a contract to say, when you give me this, I will give you this, unless these certain exceptions apply, and so on. Relatively heavy on the legalities here, long story short. And then there's synthetic liquid staking, which I understand is essentially a series of payments back and forth just to sort of manage the risk around staking, right? So, these are basically swaps, right? We have these right now for other types of commodities, and those are highly regulated by the CFTC. So if those swap positions were to trade, for example, other than by a very sophisticated kind of market actor called an eligible contract participant, then those trades would need to happen on a CFTC regulated exchange. And there are a whole bunch of other regulations on swaps. I'm frankly not the world's greatest expert, but it's a very, very complex area, and there's a high chance that many synthetic liquid staking arrangements would meet the definition of swap. So that's really it, at a high level overview of all this. I'd love questions, discussion, etc. And I'll stop sharing now.
That's great. Thanks, Gabe. Any questions?
I mean, maybe one thing that might be worth expanding on, because I think it's kind of an interesting question, and we've sort of wondered about in our conversations with you. So you have, let's say, something like delegation vouchers, right, which is in your eyes maybe mostly harmless and has a good chance of being not regulated. And then when you add sort of another token to it that then does some kind of governance, parameter management functionality, and it starts looking a little bit more like something like Maker, right? Because there also you have, again, right, okay, I can put in the Ether, I can get my DAI out, but there's also MKR, which does a bunch of stuff. So kind of, like, why does that have such a triggering effect when it comes to the regulatory side? And also the question of, if you have now a DAO that manages a liquid staking asset, is there at some point where you get like, decentralized enough so that it's, no longer, kind of a regulated thing?
Right.
And yeah, and then maybe it might be worth talking about, because I think Maker may be one of the most relevant analogies to look at.
Right, sure. Yeah, so I think there are a couple of answers, right? So to your first question, which is why does it make a difference, right, when you start adding these other things? So the first issue, I think, is differences in risk, right? It seems to be, most people seem to think, and I think maybe we've actually seen, that a system like MakerDAO can become insolvent, right? That is in MakerDAO, it happens when the price of ETH like really crashes, right? And the DAI is supposed to represent, a stable value pegged to something else, right? And then you have this issue, right? And as a last resort, they would have to sell more MKR and hope there are enough buyers so that more dollar value gets into the system, so that the DAI can hold the peg. In the liquid staking systems like Everett, it's a little bit different because stable to it would be as if MakerDAO issued PETH instead of DAI, right? It's the stable coin is something that's meant to represent the collateral or a fraction of the collateral on a stable basis. But I think systems like that can likely probably become insolvent as well, just in somewhat of a different way, right? Which is that there's some massive unexpected slashing event, right? For example, something like this. So when you have this possibility of an insolvency, that's a market risk, right? And so naturally, one of the three questions, right, we put up was, does it pose market risks, right? And yeah, it does. And then it also poses individual risks, right? Because individuals can lose their money in these situations. It's a little unclear to me whether like people staking through this versus staking directly are really incurring greater risks or not. I guess theoretically they are, because they're over collateralizing. So if it's really, really bad, they could lose more. But to me, the market risk is more of a thing that regulators will look at. The other piece of it, right, is what does governance mean, right? The holding, a bunch of people holding a governance token and setting the parameters of the system dynamically could look, even though initially it seems like it's this very different from a normal business, through a certain lens, it could look a lot like an ordinary business, right? It's like it. Let's just say, the only thing is really like most corporations don't do a lot of shareholder referendums. They just delegate management to make the decisions on the fly. But in theory, if like nearly every important Apple decision were submitted to a referendum of Apple stockholders, it would look a lot like MakerDAO in some ways. And like, I don't think that means that like Apple has no legal liabilities suddenly, right? Just because it makes its decisions through that particular mechanism. So one could view all the holders of MKR, for example, as members of an unincorporated association or general partnership who are co-managing the protocol for their profit, because it's designed to, make the token go up in value if it performs well and grows in market cap, et cetera. So, that makes them look a lot more like a custodian, right? Like a business. Right. So that's the other reason why I think there's heightened, regulatory risks for those types of systems. And then you had a follow-up question. You had a second question. I'm sort of forgetting now what it was, but.
Yeah. So there's a question of, but like, let's say once that becomes like very decentralized.
Oh, decentralized. Yeah. So I think from the securities standpoint, we do have this great precedent, which I think was brilliant on the part of the SEC to say, we're going to recognize that when the drivers of value of a token are very decentralized, that we'll stop regulating the token as a security, or we won't regulate it as a security. That to me makes it's harmonious with existing securities laws, right? Because the securities laws are really designed to force someone to make a lot of disclosures about something, so that people can make informed decisions about buying it. But if there's no, natural sort of set of affiliated persons or single entity that has the relevant information, then it doesn't make you like in the case of Ethereum, for example, what would you do? Would you have both Consensus and the Ethereum Foundation be SEC reporters for ETH? It just doesn't make a lot of sense, right? So I think they recognize that, and that's why decentralization matters in that context. Now, the CFTC has come out in a very different way, and there are arguably pretty different policy concerns, because there's no commodities disclosure regime, right? Like there is for securities. Instead, there are these market regulations. And, Brian Quintenz of the CFTC, has come out pretty strongly and said, look, if developers know that they're setting something up, that's supposed to be on a regulated exchange, and they put it out there anyway, they may face liability for aiding and abetting violations of the commodities laws. And I think so they don't seem to think that whether it's decentralized changes the legal analysis. And I think the reason for that is just that the commodities laws are built in a different way, which is mostly not transaction oriented, but commodity oriented, like oriented to a specific like type of transaction. No matter when it occurs, and not disclosure oriented at all, right? And risk oriented primarily, right? They're trying to cabin certain types of risks. So where they see those risks, most likely they will want the regulations to apply, even if they're existing in a decentralized context.
Gabriel, I have a question. I run a CFTC registered fund, so we're a CTA and CPO.
Oh, great.
And we transact a lot in swaps and in the asset lending market, so more of like, let's call it a repo market.
Mm-hmm.
And this might be a little bit too much of a tax question, but I'm just curious on your thoughts about it. When you look at ETH1, ETH2, right, you'll have two different blockchains running at the same time. And what we've been just contemplating is, we could offer out to our ECPs a type of swap, for staked assets so that the assets aren't locked up. But one of the questions that we've been looking at is really, does that become a step up in basis? Meaning you've sold your ETH1, you're on ETH2. And I know technically it's locked up in a deposit contract, but again, because you have two different type of assets,
right?
I'm just curious on
yeah, I've so I'm not a tax lawyer primarily. I'm a corporate securities lawyer, but I have dealt with issues where I've collaborated with tax experts who've weighed in on this, and they do have concerns about that type of thing going from one chain to another, even if it's not changing even when it's like crystal clear that it's not changing the underlying nature of the token. I've seen them have concerns. I would think all the more so would they have concerns in this context where there's actually like materially different functionality, that's unlocked by moving to the beacon chain. That being said, beyond that small soundbite is somewhat out of my depth. But what I would do is I'd love to offline I'll hook you up with my tax partner Jonathan Van Loo. He could provide much better insight on this question.
That'd be great. Thanks.
Maybe a question that might be interesting. So, we've, Felix, Brennan, and I, right, we've read your drafts a few times, right? So we kind of wrapped our head a little bit around it, but I think most people here have probably not read it or maybe just skimmed it once, since, it just got out yesterday, basically. So, for those who are, some on this call also are like, thinking of launching some kind of liquid staking protocol. Like, do you have any kind of like advice on how to approach that?
Yeah, so I would obviously you want to analyze it specifically, right? What your specific system, and not worry too much about what other people are doing, because I get that a lot. Well, they're doing it, and they have a big investor, so they must have hired a big fancy lawyer, and they must have said it's all okay. Not necessarily. You'd be very surprised. So look at your specific system with your own lawyer, right, and really think about it. And then I would say where you see pain points, right? Think about whether those can be massaged in some way, like in a real way, not through theatrics, to reduce the legal issue. That's sort of the first line of defense. The second line of defense, where you say, no, these properties are essential to making this work, right? And we still have the legal issue. get a lawyer and talk to the regulator, because I do think the regulators are very willing to engage. And anecdotally, I know of other lawyers who have gotten good results, with the CFTC on DeFi projects. Sometimes surprising things, right? Like, just the fact that we do have these smart contracts and anyone can permissionlessly, access them, right? But, from what I've heard in the wild, right, the regulators have been kind of willing to say, well, you just tweak your front end, right, to exclude U.S. persons, or to make sure U.S. persons, interact with it in a specific way that does comply with the rules, and we'll be okay with that, right? Because we realize you can't control everything that happens on a smart contract, that sort of thing. So I do think there's a lot of flexibility with the regulators. It's not infinite, obviously, but I would say engage is the way to go, right? Unless you just want to be totally cypherpunk and don't tell the world who you are, just launch the project, right? And just hope that they don't find you, right? But personally, I like to sleep well at night, and I recommend others find a way to sleep well at night.
Yeah, I mean, that does tie into another question that might be interesting to get some of your thoughts on, although again, this may be not so easy to answer in the abstract. So sure, talking with the regulator is obviously one path. I think there's going to be another path where, right, like many projects are just going to go ahead and do it,
Sure,
right? Because
of course.
this is the same, right? If you had wanted to do token sales and ICOs, and
Right.
talk with the regulator, probably wouldn't have worked out. And
Yep.
there's been a tremendous amount of benefit that's come out of that, after all. So what do you think are, like, when people go ahead and they launch either native liquid staking, or maybe with some sort of DAO interjected, like, what do you think are the most likely repercussions and ways that regulators are going to basically intervene?
Yeah, I mean, I think we've seen it, right? There are fines. There are, sometimes there are personal fines. Sometimes there are entity fines. Sometimes there are limitations on how you can do business in the future, right? Like, you can effectively be barred, from the securities industry, right, for a securities law mistake, this sort of thing. So, absent fraud and things like that, I would expect that, these would be the penalties. I do think that sort of the, the SEC's kid gloves, are coming off, right, little by little. They, initially had this DAO report, right, and they said, okay, if you did your thing before the DAO report, we're not going to mess with you, even though we could if you did it after. But they kind of ratcheted it up over time, right? And we've seen the fines get bigger. Now we've seen litigation, right, with Telegram and Kick, and that got pretty nasty, right? The SEC was basically able to destroy Telegram's entire project, right, after people had already invested like over $1 billion in it. So I think it'll scale up. Now the CFTC is interesting because they've basically just only gone after fraud so far. So I don't know whether they'll follow a similar kind of escalation pattern. They did just release what could sort of be looked at as like their DAO report in March, which is their guidance on what actual delivery means in the context of leveraged crypto retail commodities transactions. So maybe they're just kind of starting that process, or maybe they go 0 to 100 on some particular DeFi project. There's really no way of knowing at this point, but overall I think their approach is constructive.
Any other questions? Anyone else on the call?
Well, if you guys think of other questions later, feel free to tweet them out to me or whatever. I'm always happy to try to field that. Or, if you have a project that you might need advice on, happy to set up a call or something like that.
Yeah, no, I think that's the. Thanks so much for the offer, and thanks for your amazing work. I mean, you sort of downplayed your work there, but I think it's you know, you went to so much depth, and it's thinking through a lot of issues that are, you know, relevant to staking, relevant to liquid staking, but you know, you can kind of see them all coming together in this DeFi, right? Because most of those issues are not actually particular to staking. They're more particular to sort of these dynamics of, oh, you have like one asset that's in some sort of escrow type state, and another asset that maybe gets backed by that, and then how that is managed. So I think what you wrote, I think, has a great applicability going much beyond just staking and liquid staking, but you know, in general, this clash between, you know, decentralized DeFi, decentralized DeFi and existing regulations. So yeah, I think it's, you know, super interesting, and it's going to be extremely interesting to see how this is going to play out.
Awesome. Well, thank you so much, everyone. Great to meet you all, and hope to encounter you in the wild.
That was great. Thanks a million, Gabe.
Yeah.
And thanks to everyone who's on the call and everyone who's participated in all the liquid staking calls. It's been a great pleasure. So thanks a lot.
Thanks, everyone.
Thank you, guys.
Cheers. Thanks.
Bye.